What's up, everybody? It's Squeakly, and let's talk about why I think investing should be more like watching paint dry than, watching a Formula One race. Now, I get it, the whole idea of trading stocks, buying low and selling high, it sounds super exciting, right? You see these stories of people making a killing overnight, and it's tempting to think, hey, I could do that too. But trust me, for most people, that's a recipe for disaster. The real secret to building wealth in the stock market isn't about chasing quick wins or trying to time the market perfectly. It's about something much simpler, much more boring even, and that's exactly what we're gonna unpack today. One of the biggest myths out there is that you need to be some kind of market wizard to make money in stocks. Predicting the exact moment to buy and sell for maximum profit. But the truth is, even the pros have a really hard time doing that consistently. What they do understand, though, is that time in the market is way more important than timing the market. Think of it like compound interest. The longer your money's invested, the more it has a chance to grow exponentially. It's like that old saying, the best time to plant a tree was 20 years ago. The second best time is today. So instead of trying to be a market timer, be a market timer. Let that money compound and do its thing. Now, if you're anything like me, you probably don't have hours to spend every day researching individual stocks and analyzing market trends. And that's totally fine. That's where passive investing comes in. With passive investing, you're basically hitching your wagon to the performance of the entire market. Think of it like investing in a diversified basket of stocks, like the S&P 500, through low-cost index funds or ETFs. This way, you're not betting on any one single company or sector, you're spreading your risk across hundreds of them. And the best part? It's super low maintenance and usually comes with much lower fees compared to actively managed funds. Even Warren Buffett, one of the greatest investors of all time, recommends this approach for most people. Chapter 3. Emotions are the enemy. Let's face it, investing can be an emotional roller coaster. One day the market's up, the next it's down, and it's easy to get caught up in all the noise. But here's the thing, emotions are the enemy of good investing decisions. When you make decisions based on fear or greed, you're more likely to buy high and sell low, which is the exact opposite of what you want to do. That's why having a long-term perspective is so crucial. It helps you tune out the day-to-day fluctuations and stay focused on your overall goals. Remember, slow and steady wins the race. Chapter 4. The bigger picture matters. Instead of obsessing over every little market dip and spike, shift your focus to the bigger picture. Look for companies that have a solid track record, a strong competitive advantage, and are in industries that you understand. Ask yourself, is this business likely to be around and thriving in 10, 20, even 30 years? If the answer is yes, then short-term market fluctuations become a lot less important. Remember, you're not just buying stocks, you're buying a piece of a business. So choose wisely and invest for the long haul. So look, I hope this video has convinced you that stock investing doesn't have to be this high-pressure, stressful endeavor. In fact, the less you try to time the market and the more you focus on consistency, diversification, and keeping your emotions in check, the better off you're going to be in the long run. Remember, building wealth takes time, it takes patience, and it definitely takes a lot less stress than some people make it out to be. As always, make sure you do your own research and maybe even talk to a financial advisor to figure out what's best for your own personal situation. Until next time.